Two Australians each end the year $200,000 better off. One of them pays about $60,000 in tax, the other pays closer to $20,000. Nobody broke a law, nobody used an offshore account, nobody hid a single dollar from the ATO. Both of them could have their returns pulled tomorrow and both would be fine. The entire gap comes down to one thing: how the money arrived and whose name it landed in. The first person has a job, the second person owns things. I'm going to walk through the four moves that create that gap in order of how much they actually affect it. Then at the end, I'll go through what works on an ordinary income because two of these are far more accessible than people assume, and one of them costs you nothing to start using this week. Australia taxes your salary on a sliding scale. The first $18,200 is free. After that, it steps up through 15%, 30%, 37%, and at the top, everything above $190,000 gets hit at 45 cents. Add the 2% Medicare levy, and you're handing over 47 cents in every dollar at the top. That 47% is a ceiling, but it's a ceiling that mostly applies to one narrow category of money: income you generate by turning up and working. The Tax Act treats three things very differently: money you earn from labor, money your assets earn while you hold them, and the gain your assets make when you finally sell them. Wages sit at the top of that list and get taxed the hardest. There's almost no flexibility in how they're treated. Your employer withholds tax before you ever see the money, the amount is reported directly to the ATO, and there is essentially nothing you can do to change the timing or the rate. Move down that list and the treatment softens at every step. You get control over when the tax event happens, you get deductions, and at the bottom, you get a discount written directly into the legislation. So, every serious tax strategy in this country is a variation of the same move. Shift as much of your financial life as possible out of the first category and into the third one. Let's start with the discount, because it's the largest concession in the system and almost everyone watching is already eligible for it. Buy an asset, hold it for more than 12 months, sell it. Only half of the gain gets added to your income, the other half is simply not taxed. That means the highest possible rate on a long held capital gain in Australia is 23.5%, exactly half of 47. So let's put real numbers on it. Someone earns $400,000 in salary over a year and hands over roughly $180,000 in tax. Someone else makes a $400,000 gain on shares they bought 2 years ago and hands over roughly $94,000. It's the same amount of money, but nearly $90,000 of difference. And there's a second advantage buried in there that gets less attention. You choose the year. Your salary is taxed the moment it's paid, whether you like it or not. A capital gain is only taxed when you decide to sell. So you can hold an asset through your peak earning years, let it grow untouched, and realize it in a year when your income has dropped. Two rules to keep in mind for later in the video. Individuals get the discount, trusts get the discount, but companies get nothing at all. Which brings us to the strategy that gets argued about at every single election. Negative gearing gets talked about like it's a property thing, but it's a borrowing thing. It works on shares as well. You borrow money to buy an asset that produces income, and if the interest and the running costs come to more than the income it produces, you've made a loss on paper. In Australia, that loss doesn't sit trapped against the asset. It comes straight off your other income, including your salary. So, on the top rate, every dollar you lose on that property only costs you 53 cents. The tax office effectively covers the other 47. Now, deliberately losing money is a strange strategy on its own. The loss isn't the goal, it's the entry fee. Here's how the full cycle works. Every year you hold the asset, you claim deductions against your highest marginal rate. Some of those deductions aren't even cash leaving your pocket. Depreciation on the building and the fittings reduces your taxable income without you spending anything that year. Meanwhile, the asset appreciates quietly in the background, and that growth is completely untaxed for as long as you hold it. No annual bill, no reporting, nothing. Then, when you eventually do sell, the 12-month rule kicks in and you're taxed on half of the gain. Deductions going in at 47 cents, gains coming out at 23.5. Around 2 million Australians report rental income each year, and a large share of those properties run at a loss on the return. That's the structure working exactly as it was designed to work. Now, this is where the gap from the intro really opens up, and it's the layer that most people have heard of without ever seeing how it operates. A discretionary trust, usually called a family trust, is a legal structure that holds assets on behalf of a group of people. There's a trustee who controls it, a deed that sets the rules, and a pool of potential beneficiaries, typically everyone in the family. The trust itself pays no tax on one condition. It has to distribute all of the income before the end of the financial year. Whoever receives that income declares it and pays tax at their own personal rate. And this is the whole point. The trustee decides who gets what every single year, and they've already seen everyone's income for the year. So, you take a family, two parents earning well into the top brackets, two adult children at university with no income of their own. The trust owns the share portfolio and the investment property, so the dividends and the rent land in the trust rather than anyone's personal name. Push $45,000 of that income to an adult child with nothing else coming in, and the tax bill is over $4,500. The tax free threshold absorbs the first $18,200, and the rest sits in the lowest bracket. Leave that same $45,000 in a parent's hands at the top rate, and it would cost about $21,000. Same family, same money, around $16,500 of difference in a single year decided by a signature on a document. Repeat that across 10 years and two children, and you're looking at a six-figure outcome from paperwork alone. However, there are real limits. Children under 18 get taxed at penalty rates on this kind of income, so it does nothing for toddlers. The distribution has to be locked in before the 13th of June, and if the trustee misses that deadline, the undistributed income can be taxed at the top rate anyway. And since 2022, the ATO has come down hard on distributions that only exist on paper, where the income is credited to a low taxed family member, but the parents actually control and spend it. The structure works when the money genuinely goes where the document says it goes. There is one more layer, and it solves a problem the trust creates. Eventually, a family runs out of low rate people. Once every beneficiary has been filled up to the bottom of the next bracket, the leftover income has nowhere cheap to go, so it gets sent to a company instead. A small company pays a flat 25%, no sliding scale, no top bracket, no Medicare levy. Instead of that income being taxed at 47 cents, it's capped at 25 and stays inside the company, where the remaining 75 cents keeps getting reinvested. Over a decade or two, compounding on 75% of your income instead of 53% is the difference between two completely different outcomes. The catch is that the money inside a company isn't yours to spend. You take it out as a dividend and it's taxed in your hands, though the company tax already paid comes back to you as a credit, so you're not taxed twice. Borrow it out instead, and there are rules that force you onto a formal loan with interest repayments. And remember, companies get no capital gains discount whatsoever. It's a rate cap and a timing tool, and it does not make the money free to spend. Everything I've described is in the legislation deliberately. None of it is a loophole in the sense of a drafting mistake. What the ATO does have is a general anti avoidance rule. If they look at an arrangement and decide the dominant purpose of it was obtaining a tax benefit rather than any real commercial or family reason, they can unwind it and tax you as though you've never done it. That's the actual line. It isn't about complexity, and it isn't about how much you save. It's about whether the arrangement exists for a genuine reason and whether what happens in reality matches what's written down. Structure holds up when the substance and the paperwork agree. They collapse when they don't. You don't need a trust or company to use the same underlying logic. 5 things in order of how much they're worth. 1. Hold longer than 12 months. Selling at 11 months and 3 weeks doubles your tax on the entire gain. This is the most expensive avoidable mistake ordinary investors make, and it costs nothing to avoid. 2. Salary sacrifice into super. Contributions are taxed at 15% going in. On a $100,000 salary, that's a saving of 17 cents on every dollar you redirect. And if you haven't used your full cap in recent years, you may be able to catch up on the unused amounts from previous years in one hit. 3. Own investments in the lower earning partner's name. The income gets taxed at their rate while you hold it, and so does the gain when you sell. It's the same income splitting logic as the trust, using a structure that you already have. 4. Choose your sale year. Heading into parental leave, a career break, a study year, or retirement? That low income year is the cheapest year of your life to realize a gain, and the difference can run into tens of thousands of dollars. 5. Control the timing of deductions. Bringing a deductible expense forward into a high income year or pushing income into a lower one does the same job on a smaller scale. The gap in that first example doesn't exist because one person was smarter than the other. It exists because the system prices working and earning on two different scales, and one of them arranged their financial life around being an owner. That door isn't locked, it just opens slowly, and it opens wider the earlier you start pushing on it.